Hey everyone, my name's Justin Long. Just wanted to welcome y'all to Accounting Basics. So it's part of our Summer of Accounting series that we're doing because what's more fun than a summer full of accounting? Yes. But yeah, sweet. But yeah, well, I've got my name's Justin. I've got Jeff here who actually will be walking us through all of these steps. But I'm actually excited about this one because it's a very practical look at just some of the words that we use when we're talking through accounting, which me as a if there's any non non business people, more of the communications or worship that stumbled into this meeting. That's kind of where a lot of my background comes from. So I've appreciated just getting to learn some of these because it gets confusing when you start talking the designated, restricted, all this. What does it mean and where does it go? So I've already gotten to get a little preview from Jeff, and he does a great job doing it. But we'll have a time at the end to where you can ask any questions you have. There's a Q&A section up at the top. If you click that, you can type in your question at any point while Jeff's going through everything. Or if you can't find that, you can just type it in the chat and we'll make sure we get to as many as possible at the end. And after this, it's typically by the next business day, we'll have a recording sent to everyone who registered from this. So don't worry if as we're flowing through, if you miss something, you'll get a copy of the video afterwards. So we'll check that. But yeah, Jeff, you want to take over?
All right. Well, thanks, Justin. So, like Justin said, today's goal is to help make church accounting terminology and reports feel less intimidating and easy to understand. So, the goal is really to make church accounting feel less intimidating, right? I know a lot of people in this are not who work in church finances are not professional accountants. Maybe you're a church administrator, a treasurer, a finance volunteer, staff member who simply needs to understand what you're seeing inside a power church. And often the hardest part is just the language. Like accounting, like every other field, has its own language, has its own terminology, its own vocabulary. So we're going to spend a lot of that. We're going to really try to simplify things, and we're going to tear apart some transactions and view how the information flows through different reports. So today we're going to simplify some of the most common accounting concepts and reports and transactions, and hopefully everything will make more sense when we're done. So the first thing here, we just kind of want to take it as a moment and say, what does a church bookkeeper do? We know many of you have their job, your job description is a lot bigger than this. So this is kind of what we're defining as church bookkeeping tasks. If you're a treasurer, your job description is bigger than this. If you're an admin, you have a much bigger job description than this. But this is kind of like what we view as kind of the church bookkeeping duty. So you're entering every outgoing payment the church makes. Now, this includes online payments and things that happen automatically. Things like bank charges um, need to be recorded as well. You're also entering every deposit that goes in, and these are coming in from many more places nowadays. This is not just cash and checks that received on Sunday morning. This is deposits that are coming in from online giving services like Vanco, interest that is coming in, maybe deposits that are coming, online stuff that's coming in um, through Venmo or other payments as well. You also want to make sure you record all the money transfers between church accounts. This could be from one checking account to the other, money that's being moved from a checking account to the savings account or to a money market account. One of the things my accounting professor beat into our heads was your accounting transactions should match what's happening in the real world. And also part of the kind of the duties of the church bookkeeper is updating the budget every year. There might be a different committee that's developing the budget, but you're probably going to be putting the budget in the program. We're not going to talk a lot about budget today, but this is kind of the um, scope of like what's in the church bookkeeper, one of their duties. You're going to be reconciling each bank account each month, and this can include credit card transactions or credit card statements. So that you make sure that all the credit card purchases got recorded within PowerChurch, and you're reconciling all the payments and any credit card purchases happening as well. And then you're going to run some basic reports. The main reports that we're going to look at these today is the income and expense statement that shows monthly transactions, shows monthly in and out, and the balance sheet. The balance sheet's going to show bank balances, liabilities, and fund balance. So we just kind of want to start with just a definition of kind of what church bookkeeping is. Now, there's much more to it, but these are sort of the basics, bare minimum. Some of the other things would fall into more church treasurer. Obviously, there's other places about helping define the budget. They're a little outside the scope of the bookkeeper itself would be entering the budget and making sure the budget is up to date within the program. So what we are going to cover today in this is we're going to look at types of accounts. We'll talk about different types of accounts. We're going to talk about some basic accounting concepts. We're going to talk about the debits and credits, and a lot of people get really when we start talking about debits and credits. Hopefully we'll make it a little easier to do. We'll go through some practical examples, and then we'll also talk about financial reports. So this is designed to be a foundational session. The goal is simply to become more comfortable with accounting concepts. Now, I need to say this, today's discussion is meant to provide general information and guidance. It's not legal, tax, or accounting advice. Every nonprofit or every church and every situation is different. So if you feel uncomfortable about things, you really need to talk with a local qualified CPA or attorney who can review your situation and to make the best decisions for your organization. So the first thing we're going to do is we're going to start with the building blocks of accounting. We're talking about different types of accounts. So everything in accounting revolves around accounts. The chart of accounts is our basic organizational structure for your church finances. Every transaction gets recorded into 2 or more accounts so the software can categorize an activity. So there are 5 account types that we want to focus on. And that's assets, liabilities, net assets or equity. We'll talk a little bit more about that, and income and expenses. So assets is pretty easy. Assets are things the church owns. The examples of this is going to be a checking account, a savings account, a money market account, maybe investment accounts. It could also include equipment and vehicles. They can or cannot be included on assets, and petty cash. Even some like more ones that are really less common. We've had churches that have had things like utility deposits that get recorded as an asset. Those are all things that the church owns itself. So that's kind of the thing, like if it's something you own, it goes on assets, it goes in the assets section. Now liabilities, the easy definition of that is somewhere the church owes money to. Now that's going to be a loan, that could be a mortgage, it could be a credit card, the amount that you owe on a credit card. It could be taxes payable for payroll liabilities of money that's been withheld from employees' paychecks but not been paid off to the state or the federal government. It could be unpaid bills. That's going to be in the course of an accounts payable as well. So the accounts, assets and liabilities are pretty easy to understand. Now, net assets represent the difference between what a church owns and what it owes. Churches commonly use the term net assets rather than equity. Now, how these accounts are used is one of the biggest differences between for-profit and nonprofit accounting. And there's a couple of different names for these accounts. In for-profit accounting, we typically see the word equity. You'll see accounts in for-profit accounting like owner's equity or stockholders' equity if you've taken an accounting class. In nonprofit accounting systems, you might see the term fund balance. That gets confusing when you're talking about accounting fund or balance of a donor restriction. And so that name fund balance is still used some, but it's not used as much as anymore. The more likely term you're to see nowadays is net assets. You'll see I'll often refer to equity because that's an easier term for people to understand. The key point here is the terms equity, fund balance, and net assets can almost be used interchangeably. So don't get confused when you see all of them. We'll try to use the term net assets, but I'll probably say net assets / equity as we go through today. But net assets is the correct nonprofit current accounting name, and you'll find that when you're looking at a nonprofit accounting textbook as today. So at a high level, the net assets are the nonprofit of equivalent of equity accounts and for-profit business. In simple terms, the difference between what a church owes and what it owns. So net assets are calculated. The total net assets is we take the total of assets minus the total liability equals our net assets. So if you think of it that way, it's equity. Equity is the total of what you own minus what you owe is your equity. Same thing, but we're not using the term equity, we're using the term net assets. Another way we can say this is we can say assets equals liability plus net assets. Same formula, we just used a little bit of algebra to move things around. When you actually look at the balance sheet, this bottom one is the accounting transaction, or the what you'll see on a balance sheet. You'll see assets on one side and liabilities plus net assets on the other. That's the equation that you'll see on the balance sheet. So if a church has more assets than the liabilities, that's a positive net assets. And one thing we're going to talk about later here is that how income and expense accounts eventually affect the net assets, how the flow is from the income statement and how the net assets get updated from our income. Now, one of the core differences between nonprofit accounting and for-profit accounting is restricted versus unrestricted net assets or equity. You may also hear these accounts referred to as with donor restrictions or without donor restrictions. The official terms for those is now currently that's in your equity section is with donor restrictions, without donor restrictions, but to be honest, that's a mouthful. We're just going to refer to it as unrestricted and restricted today, just to not make the big full mouthful of them. The important difference is that nonprofits must track whether money has donor-imposed restrictions attached to it. So the examples of this, and we'll talk about this a lot today. If someone gives a donation to support general operations, that would normally be considered without donor restrictions. In our wording here, we're going to use the word restricted or unrestricted. Tithes and offerings would be an example of unrestricted giving and would appear in that unrestricted section in the net assets. But if a scholarship is given or money is given specifically to send kids to youth camp, that's happening in my church right now, those would typically be classified as with donor restricted or as restricted net assets. And you're going to have a separate net asset account for each balance that you want to track. So if we need to track how much money has come in for camp scholarships, that would be tracked in a restricted net asset. These net asset accounts help you track the remaining balances of each restricted fund over each donor restricted fund over time. And your income and expense accounts are going to be configured to close to a specific net asset account, whether that's unrestricted or restricted. And they're going to close to or update those accounts at the end of an accounting period. Now, behind the scenes, PowerChurch does that closing to process, and we're going to kind of talk about this a lot for you. PowerChurch knows when the balance of an equity or net asset account needs to include the close to amounts and includes the right amounts automatically. This is not something you do or worry about, but you want to understand that it's happening so that you can see and understand how the balances in these net asset accounts are calculated. Okay, so let's go on to our next type of account. Our next type of account is an income account. Now, one of the settings on an income account is you're going to specify with it what net asset account it updates. So common income accounts is going to be things like tithes and offerings. That's going to close to our unrestricted net assets. Other things like missions giving, if that's coming in as a part of a donor restriction, that's going to close to a restricted net asset account. Other types of things you might have, other income is going to be rental income, event income. You might have interest income that's coming in. Those are all going to be examples of income accounts. We also have expense accounts. When we're setting up an expense account, there's going to be a setting when you set up an expense account that you're going to specify what net asset or what equity account that expense account updates. So things like utilities, salaries, curriculum, maintenance, those are probably all going to close to unrestricted net asset account or equity account. Things like mission support, that could be unrestricted. That's coming out of the budget. If you're receiving donor restrictions, something like for a benevolence, you might have a benevolence expense account that's updating the donor restricted net asset account. So that's one of the settings that's in there. Now, one thing to understand about income and expense account is they are temporary. Now, what I mean by that is they're tracking the amount that's happening during a period of time. This could be a month, this could be a year, but when we look at income and expense statement, it always has a beginning and an ending date. Now, we might just say this is the income and expense for May 2026, but there's an implied date period in there. We're talking then about May 1, 2026 through May 31st, 2026, right? That we're talking about a month. Or if we say year to date, it'd be January 1, 26 through the end of May, because that's where we are at now. So they track the activity during that period, and eventually their balances are going to move over to net assets. That's part of that whole closing process. So we're going to talk a little bit about that, because we want you to understand how the money moves from the income statement over to the net asset area. So during the year, income accounts track money coming in, expense accounts track money going out, and all that activity appears on our income and expense statement. But at year end, those balances close to their net assets. So in simple terms, the financial activity becomes part of the church's overall financial position that's shown on the balance sheet. So for instance here, so we'll take an example. So say we have $5,000 or $500,000 of income come in for the year, and we have $450,000 expenses. We have $50,000 of surpluses. We'll see a $50,000 increase in our net asset section in that case. Now it might be broken up over several different net assets accounts. We're talking just in general overall of how that works. So the simple way to think about this, the income statement tells the story of the year, and the balance sheet shows where the church stands after that story is added into net assets. So we're taking a deeper look here on how these reports or how the accounts work together. Assets, liability, and net assets, they all show in a report called the balance sheet, which we mentioned a couple of times here. Income and expense accounts, they show on a report called the income and expense statement. They'll have a closing process that the amounts from these income and expense accounts will close and update to accounts in the net assets section. And that's kind of how the money moves from the income statement to being shown on the balance sheet itself. There again, this is the closing process. It's not something that you do. The PowerChurch knows when those balances here in the net assets need to include the closed to amounts, but there we want to understand how that process is working so that you can understand how those balances are calculated and not feel lost of where these numbers all are coming from. Okay, so it's time to talk about debits and credits. And so PowerChurch and most accounting systems use something called double entry accounting. And this is one of the most confusing accounting topics for beginners is the debits and credits. But once you understand the basic pattern, it makes sense. It'll make more sense. And it simply means every transaction has to use at least two accounts. This keeps our accounting system balanced and accurate. So let's talk about the relationship between debits and credits. A debit does not automatically mean an increase, and a credit does not automatically mean a decrease, or vice versa. Usually we think of the same way. If we credit somebody's accounts, we think it's increasing. If we say a debiting account, we think it's decreasing. Debits and credits really just mean left side and right side of our accounting equation. So if we go back to that main accounting equation, and a lot of accounting goes back to this, we have assets equals liabilities plus net assets, or liabilities plus equity. So remember, our accounting equation is assets equals liabilities plus equity. Assets are on the left side of the accounting equation. So they have a debit balance. So that means money coming into an asset. To increase it, we debit it. Liabilities are on the right side of the accounting equation. So amounts in a liability account, to increase a liability account, we credit it. Same thing with our equity. To increase an account in the equity side, we credit it. And so all that kind of makes sense, right? So we can easily see that. But what about income and expense accounts? Where do they fall? So one way to think of income and expense account is they are really, because they're updating the net assets, they really are part of the net asset area. So when income comes in, it increases our equity. You know, if we get a paycheck, our equity goes up. Right? Same thing when the money comes into the church from a contribution, its equity goes up. So income accounts, when we credit them, they increase in value because they're turning around and increasing our equity. Now expenses, that's money going out. So when we spend money, our equity goes down. So they come in as a debit because to decrease an equity account, we need to debit it. And it might not make a whole lot of sense, but when you think about the closing process, income and expenses, we want to look at how they affect net assets to determine whether they are debit or credit. We'll simplify this in just a second. I've got a chart here next. So here's a chart that shows each account type and what increases or decreases it. So assets are increased by debits, decreased by credits. Expenses are increased by debits and decreased by credits. And our liability, income, and net asset accounts are the opposite. They're increased by credits and they're decreased by debits. They're decreased by credits. So the key concepts here is debit doesn't always mean increase. Credit does not always mean increase. It all depends on the account type. If you say I'm debiting or crediting an account, you also need to know what type of account it is, whether to know how that's going to affect that account. So now we've confused everybody, we're going to make it a little simpler. one way to think about the general rule from accounting transactions is think about the flow of money. So an example we're going to use here, if we think about money flowing from one area and going to another area. So we're going to first look at an example of recording a contribution deposit. So if we think about this as a contribution deposit, money's coming from income, right? We received income coming in. So it's coming from income and it's going into our bank account. So we always credit where the money comes from and we debit the destination. So, if you think credit coming from C for C and the debit destination D for destination, where the money goes. So that's a simple way to do this. That's a simple way to track this. So if you always think of where credit where the money comes from, debit where the money's going to, or where its destination is. Our next thing is we'll look at a utilities expense here as well. So where's the money coming from? Well, in this case, the money's coming from our bank. When we credit an asset account, it goes down in value. So we think about the money coming from out of the bank account, we're crediting it, it's going to the utilities, its destination is the utilities expense account, and it's being debited. We debit an expense account, that makes it go up in value as well. So the easy, like I said, the easy thing, if you can think about coming from and going to, or crediting the source and debiting the destination, whichever way you want to do it, and that works most of the time. Sometimes you get into kind of an adjusting entry, someone you might have to revert back to there, but our basic accounting transactions, the things we're talking about here, recording income, recording expenses, this pretty much always works. It's getting some other things when we're having to do some adjusting entries, we might need to fall back to the table to say, okay, I need this account to go up or down, and then figure out whether we need to debit or credit that entry. All right, so we're transitioning now to talking about accounting reports. The two most accounting reports that we're going to look at is going to be the balance sheet and the income and expense statement. And each of these answers a different question. So the first report is the balance sheet. The balance sheet shows the church's financial position at a specific point in time. So it's going to include accounts, it's going to include our asset, our liability, and our net asset accounts. The simple way to think about this is what does the church own and owe right now, and owes including in the net assets our donor restricted amounts. So let me go ahead and switch to the next slide here. So we'll see here on our things on our assets, we've got a bank account. I went ahead and listed the building here because we do have a mortgage. So it shows liabilities show our mortgage. It's also going to show our donor restricted amounts that we owe. One way to think about the balance sheet is this way, is like what we have and then who has claims on it. So if we think about we have a $10,000 in the bank and a $100,000 building, there's a claim of a liability of $75,000 of that building. And we have claims over here of $5,000 that we owe for donor restricted for donor restricted giving that we need to keep track of these balances. So that's one way to think of the balance sheet. Now, one of the things to notice that your balance sheet should be in balance, and what we mean by that is assets equals liabilities plus equity, right? Or net liabilities plus net assets. So we see $110,000 assets. We see that we have liabilities and net assets of $110,000 as well. So those two numbers should always balance. Our second report that we're going to look at here is the income and expense statement. This shows the financial activity over a period of time. We talked about this earlier. This could be the month of May 2026. That would include May 1 through May 31st, or be by January through May 26. So this is going to show us how much money was received, what our expenses were paid, and shows whether the church had a surplus or deficit. So this answers the question, how did the church perform financially this month or year? And you're typically going to see giving totals, how money was spent, and our overall operating results. So we'll just look quickly at this entry here. We're going to delve into this probably a little bit more later. We see that we had $1,000 come in from tithes and offerings. We had $250 worth of benevolence income for a total income. We're going to see that we spent $300 on utilities expenses. We spent $175 on benevolence. And so that we had a net income or total income of $775. This is a really cut down example just so you don't get lost in all of the numbers of what we'll see on an income and expense statement. Now, a full one, when doing this, would probably also include budget numbers. There's a bunch of options that you can include in PowerChurch, but we're really just narrowing this really down to the very basics so we can get the ideas of what's shown on each of these. So how the reports connect, again, we kind of mentioned this before. The income expense statements eventually affect net assets. So money comes in, the closing process kind of moves the balances that have come in here and up, and those are shown on the balance sheet. So when a church has a surplus, the total net assets increase, and then when a church has a deficit, the total net assets decrease. That's how transactions that are eventually in that the totals are shown income expense eventually end up and affect the balance sheet. So now we're going to walk through some examples of accounting transactions and see how they affect our all of our reports. So our first example here is we're going to look at money coming in. This is unrestricted contribution. So we received a tithes and offerings of $1,000. Go back to our debits and credits. Money's coming from tithes and offerings. So it's going to credit the tithes and offerings income account, and we're going to debit the bank account. So credit where the money's coming from, debit where the money's going to. So here's our transaction. Up here at the top, you notice it's debiting the bank, it's crediting tithes and offerings. Credit where the money's coming from, debit where the money's going to. Now, the $1,000 from our debtor debit here, it moves straight down to our bank account. We're starting everything off here with zero, so it's all building. So this $1,000 shows here straight in the bank account. Our $1,000 of tithes and offering is going to show on the income statement as $1,000. So the question is, how did this get the unrestricted also increased by $1,000? Well, tithes and offering income, one of the settings in it says, hey, I update the unrestricted, or I close to the unrestricted net asset or equity account. So it PowerChurch basically includes this $1,000 from the tithes and offering over here, and that's how this balance gets calculated. It actually comes through the income account. This might seem really basic, but this is kind of a hard concept for a lot of people to get, of how this number gets updated. So this number kind of gets updated through the income statement. So that's one example of how that flows through. So now let's take a look at the next example. Now we're going to complicate it a little bit, and we're going to look at donor restricted contributions and how that. We've got $250 that's coming in for benevolence. So again, we credit where the money's coming from. So we're crediting benevolence income, we're debiting the bank. Our $250 increases the bank account by $250. So we now got $1,250 in the bank account. Our credit here, our crediting benevolence income, that's shown on the income statement as $250 worth of income. The benevolence income, we've now added benevolence net asset account to our balance sheet. Benevolence income updates the benevolence net asset. So it increases the net asset by $250. We're in balance in our balance sheet, $1,250 total assets. We have no liabilities, so we've got $1,250 of net assets or of equity. That's how the money flows from the income statement over to the net asset area on our balance sheet. So now let's pay an expense. So the church is paying a $250 electric bill, or I have my example wrong. So okay, we're paying a $300 electric bill. So credit where the money's coming from, debit the money where the money's going to. This time the money's coming from the bank. So we're crediting the bank for $300 and we're debiting expense for $300. So the $300 credit decreases the amount of money in the bank. So it moved from $1,250 down to $950. So our bank went down. The $300 increases a utilities expense account by $300. And this time, the utilities expense closes to our unrestricted equity. So it's reducing our unrestricted equity by $300. So it went from $1,000 down to $700. And how those, so we can have multiple accounts on the income and expense account, all are updating a single unrestricted. So both tithes and offerings, and in our example here, utility expense, are both updating the unrestricted net asset account itself. So that's how the balances move from income expense statement over to the balance sheet. Our example here is, let's look at now paying a restricted expense. Let's let's look at paying any restricted expense. So we're paying a benevolence expense of $175. I think the question came in benevolence. A lot of churches maintain a benevolence fund. It's kind of what we're doing here. A specific need has come up within the body of that people might give. They know of a need, or they maintain a certain amounts of benevolence that people give, and then those amounts. And that's just a common thing. That's kind of what we're talking about here is benevolence. Is usually it's donor restricted amounts that people are giving, and that's why I'm kind of using this as my example for that. So we think about where this is going again. So money's coming from our bank, so we're going to credit the bank account, and we're going to debit benevolence expense in this particular instance here. So let's look at this. So here's our transaction. We're crediting the bank account. Money's coming from the bank. It's going to our benevolence expense account. There again, the $175 is decreasing our bank account by $175, so the new balance becomes $775. The benevolence expense comes down in the income expense statement. It's showing on the $175 here, and it automatically updates the benevolence equity account, and that leaves us with, we had $250 before of what came in, so that leaves us with a $75 balance in the benevolence account. So common beginner mistake. So here's very common is posting to the wrong account. As we saw here, we have a lot of accounts that have close to the same name. Like when we talk about benevolence, we have 3 accounts. We have a benevolence income, we have a benevolence equity or net asset account, and we have a benevolence expense account. So sometimes people just type in the account name and pick the first one, which might not be the exact account they want. So that's one of the things you often want to look at. Hey, I'm recording a payment. I'm recording a payment coming in, and I want to, I don't want to show that as an expense because this is money that's going, or sorry, I don't want to show that as income coming in. I want to make sure, I don't want to pick an income account. I want to make sure I spend an expense account. So that's one of the most common things, accounts there. Using the wrong fund. If you have set up multiple funds, using accounts out of the wrong fund, using the bank account from fund 2 rather than fund 1. We didn't really talk a whole lot about funds today. We're kind of bringing it back a little bit, but using accounts out of the wrong fund, reversing our debits and credits is very easy to do. So if you've done any of these, you're definitely not alone. Everybody makes them. I've made them even with lots of experience. So here's some tips. Don't post your transactions right away. When you're in PowerChurch and running reports, you can there's an option on all the accounting reports that say include unposted transactions, and you can include that. And then you can check to make sure your transactions are doing what you expect them to do. If they're not doing what you expect to do, if they're unposted, you can make a change to them. Once they're posted, they become part of the permanent record at that point. So, enter your transactions, leave them unposted, run your reports, make sure they're doing what you expect the balances to do. Once they're doing what you expect to do, then post them at that point, and they become part of the permanent record at that point. You will need to post them to be able to do things like run bank reconciliations and so on, so they will need a post. So as we wrap up here, I want to just take a moment to think about that. Remember that accounting is not just about numbers here. It is, we're using numbers, but the numbers we provide give good financial information to support ministry. Without good numbers, it becomes a guess. So we want to help churches make informed decisions. Otherwise, they're just guessing. It helps them plan responsibly, steward well, and then communicate with leadership and its members. We want clear reporting. Clear reporting builds transparency, it builds accountability, it builds donor confidence. And hopefully today we've helped make accounting terminology feel a little less intimidating. So our final thoughts is you don't need to memorize everything. Work to understand concepts first is the first step here. Like we spent a lot of time talking about how money moves through the system. And as you work with more reports and transactions, you'll get more familiar with the language and where things are going. So as Justin mentioned, this is just the first of our what we're calling Summer of Accounting sessions today. So Thomas next month is going to be doing Starting Accounting the Right Way. He's going to look at taking a clean setup, starting a clean setup of PowerChurch, With that, the month after that, Thomas is going to do bank reconciliation. Talk about the pitfalls and everything that happens bank reconciliation. And then August, we're going to take a kind of a deep dive into donor restricted amounts, keeping track of those. So that's coming up. I think there's already links to sign up for those if you want to. And I think we're ready for questions. I know some have come in already. So let's take a look at what's coming in here. All right. There was a definition of benevolence income. Benevolence income, I think we already mentioned this, is kind of would be our donor restricted income. People that are giving for benevolence giving, that's usually a donor restriction that then leadership or a committee evaluates the benevolence needs and then disperses the money from that benevolence income. There again, to track a donor restriction, we're really going to have, without going too deep in it, we're going to have 3 accounts. We're going to have an income account, an asset, a net asset, or equity account to track the balance, and then probably an expense account. Or if you're using release accounts, come back in August and we'll talk about those, of how those work as well. So that's what those are. I think some other people, would a credit card rebate be counted as a credit or should it be listed as income when thinking of income and expense? I'll give you the accounting answer, and that's it depends. So if it's a rebate for a particular expense, you could go back against that expense account and that would reduce it. If it's just sort of like, a rebate that they're giving you 1% cash back, you could count that as particular income coming in as well. One person says, after posting, you may correct a mistake by reverse and redo. Yes, that is a feature that is in PowerChurch. If you've got a transaction that is wrong, you can select the reverse and redo, and it automatically reverses the entry and then gives you a chance to edit it and then post in another entry. How to run a report without posting. I'll cover that in a sec. I'll show you that in just a second. Well, let me go ahead and switch over to PowerChurch. This takes a little bit of thing here, so let me do that and switch over to a copy of PowerChurch so that we can just take a look at that. And I need to bring this online. Okay, so now you're seeing a copy of PowerChurch. And in accounting, when we go run reports in fund accounting, so let's just say we're running a balance sheet, and all the accounting reports have, and they all have this option to say include unposted transactions. And that'll then let us run our report with unposted amounts in there. So we can verify that it's going to do what we want. So if we had a deposit, we can verify the bank account's going up. And all the reports in fund accounting now has that. If I go look at the income expense statement, there's an option here to include unposted transactions. That started being incorporated a couple versions ago, but pretty much every report has that in there. So that's how you can include transactions and report without posting. How do I find contributions that were entered but not posted? So, all right, so kind of the process through how PowerChurch works is you enter something, it goes into unposted state, you post it, and then it becomes part of the permanent record in that module. And for things like contributions, accounts payable, accounts receivable, and payroll, when we post contributions, that then creates a summary entry and transfers that over to fund accounting. So contributions follows the same thing. So contributions, if we go to modify unposted, and I probably don't have anybody, you would see any unposted contributions that are here. So if there are contributions that were entered but not posted, they're here underneath contributions, view unposted contributions. I'm sorry, I clicked view posted. Contributions, modify unposted contributions. So the workflow for contributions is you enter the contributions, they go unposted. You then post, that's kind of making a deposit. It then summarizes though and creates the accounting transactions and moves those over to fund accounting. So if they've not been posted as contributions, you'll find them underneath the contributions module. Okay. Catherine is asking about will we have some point to do customized reports. We can get there. That would be a pretty advanced topic, but we can do that one session. That'll be after August because we got them kind of planned through of kind of a session on doing customized reports. Credit card rewards. I think, are you talking about how those would come in? Typically, I would go ahead and bring in credit card rewards as an income coming in because it'd be really hard to tie them back to expense. Back to expenses with that. So I would bring them in probably as another income kind of section with that, and they'll probably be considered unrestricted money. Kristen is asking, will there be any expense accounts that are restricted and unrestricted? For example, with benevolence, we have a benevolence expense account that has a budget, but there are also times when contributions are earmarked for benevolence. Should that be separated in different accounts? In that case, yes, because if you don't, you will have, there's not really a way to separate. So yes, in this case here, because you have a budget for benevolence and also donor restricted giving for benevolence, you probably want to have a a budget benevolence expense account and an unrestricted or a restricted benevolence expense account, both, so that your budget benevolence will show up on your budget, will affect your budget. Question is, the question is, how do you make adjustments to entries on a printed check? I guess the question there is, where is the check at this point in time? If it's already been posted through, your best bet is to go to accounts payable and then reverse and reissue it. I guess the question is it changing? So the same kind of process, if we go to maintain vendor records, let's just go to Carl's Painting Company. We can say void, and if we say reissue the check, we can then void the check and we put the date we want to void it and reissue it, and we can fix any expense accounts there. Especially if the amount is changing, we want to change that back in accounts payable. And typically, you want to go back to the module where the mistake was made, or where it happened to, where you want to correct it. So if it's coming from accounts payable, you want to kind of fix it in accounts payable, especially with the amounts, especially if the amount was wrong. There again, like Carl's Painting Company, we might be sending them a 1099. So if the amount was different, that's going to affect the 1099 we send them at the end of the year. So we want to go back to accounts payable to correct that. I'm a new bookkeeper, and previous bookkeeper had benevolence income and a benevolence contribution set up. In my mind, there wouldn't be a difference between them. I mean, you might have you would have to really talk with them to see what there was, but I mean, their benevolence income and a benevolence contribution, in my mind, would probably be the same thing. I'm struggling to say what the difference would be between them. Because if you were paying it out of budget, that would come in as part of your tithes and offerings or part of a general, kind of a general offering account. Both of those would seem to indicate a donor restricted amount coming in. There's a question, how long can you leave a transaction unposted? The things that you need to do to be posted to that, why the transaction needs to be posted, is like reconciling a bank account. Like it needs to be posted before you do your bank reconciliation. There is no time limit on leaving that as being unposted, but there are certain processes that require the transaction be posted. The main one is reconciling your bank account. So you'll need to post them before you can reconcile your bank account. The question is, can the accounting system be linked to an online banking system? The answer right now is no. That is, it doesn't automatically feed in transactions from your online banking. Another question is, if we're switching from QuickBooks to PowerChurch, we'll be giving a class on how and what to initially bring over to PowerChurch. I would tune back in next month because that's setting up PowerChurch from scratch. I know that's a full month away. That's there. So, and then Pamela is asking, what report would show a ministry's actual balance? Okay, so one of the questions to make sure we're all talking about the same thing is, what do you mean by balance? I'm going to kind of believe that's worded. I'm going to take a guess here that you might be talking about budget. Like if a particular ministry has a $3,000 budget, how much of their budget is left? I'm taking a guess there. In that case, if you want to know how much of their budget is left, you're probably going to run an income and expense statement. And we didn't go over that today. It wasn't really kind of part of our what we were talking about today. But when we go run an income and expense statement, one of the options that we can include on here is budget. And then, for instance, we can include our year-to-date budget and our year-to-date budget difference. And then that would then show them, where they're at on their budget. If this is, it all depends on your definition of ministry and balance. That's why I'm kind of making the guess there that you're probably talking about what their budget, what they have left in their budget. You talk about restricted accounts as not budgeted, but they could be. You technically can put budgets on a restricted account if you expect donor restricted amounts to come in. Yes, there's a system would allow for that. The cases that I've seen is typically donor restricted stuff is outside of our budget. Usually most places budget the operations of the church and things like benevolence and so on. They might have a budget for benevolence sometimes, but oftentimes they're relying on specific donations to take care of those kinds of things. So yes, you could, if you do have that, you could budget restricted accounts. The question is like, what does that do for you? What if the money doesn't come in? What if the money goes over? You have to spend that money on those particular things. So, I mean, I guess the question is like, are you expecting to spend? I mean, are you budgeting the income? Are you budgeting the expenses? So what if more money comes in? Are you still spending more money? Or what if you've got a budget, you've budgeted restricted expenses of X amount, but the money doesn't come in? Do you not spend it? I mean, I guess that's the question there. But I mean, the system will let you can do it. Those are the kinds of things that think about, like what is that, like they're typically, the restricted accounts are kind of considered outside of budget.
And Jeff, I have a question on that. So would a use case for that possibly be if someone donated to, let's say, the traditional or contemporary worship service as a designated gift, and it was a large sum that we know, like, we're going to bring that into our budget for this calendar year, and we're going to use this percentage of it, so we know that, hey, we can operate this ministry for the next 5 years because it's covered.
Yes. Okay. I do know of some churches that have received, like, people felt strongly about traditional services, so they donated enough basically to fund that for the foreseeable future. So in those cases there, they do budget that. And yes, that is all donor restricted giving because they are using that to fund those costs that are associated with that worship service. So yes, in that particular case, that particular case, that you would be considered donor restricted, and all those expenses could be considered donor restricted, and you would budget that. I mean, you're going to budget what your costs are. So yes, in that case there, I was more thinking shorter term donor restriction stuff, because a lot of stuff is more shorter term. But yeah, you can have a long-term donor restriction like that.
Yes, that's a very nice problem to have. That's having
yes.
money that you get to budget throughout the year.
Yes. A question comes in, did you offer one-on-one training to help me go through what is set up currently and what needs to be corrected? We don't have direct one-on-one training ourselves. If you're on PowerChurch Online, you can call in for support, or if you're on a supporting contract, you can call in for support. Just know Power Support's not really training, but if you've got specific questions, like, basically what we kind of say, support can answer how-to questions, not should-I questions. If that makes sense. So, if you've got specific questions, you can call in for support. On our website, there is a training tab on our website. We do work with some independent third-party trainers that are familiar with PowerChurch, that you can find those lists there, and you can ask them what their services are. A lot of them will work remote with you if they're not in your area as well. Okay. one of the questions was, can you choose which contributions to post, or do you have to post all of them? Let's just show that real quick. How are we doing on time? We're doing good on time. Let me just enter a contribution real quick here. And so I've got 2 contributions entered. So now I'm going to go post those. So when I go to post, I'm going to say, hey, what do you want to do? Update fund accounting. So that'll create the accounting transaction over there. You can choose by payment method what to post. Oh, I didn't mean to choose that. Let me enter contributions again. I meant to actually pick. I'm putting them on separate dates. Okay, so now when I post, I'm say update fund accounting. I can select what payment method to post. But now, since I've got separate dates, you can select by what day you want to post, so that they will post together. You can't select individual contributions. If I say continue from here, it'll post them there. So you can't cherry pick and individual contributions and post it like you can in accounts payable in there. All right, so question is, how do you designate a fund as restricted or unrestricted? You don't really designate a fund, you designate a net asset account or an equity account. So on the equity account itself, if we go look at our equity accounts here, the equity account's gonna be the 3000 section. There's a category here that says it's on the equity account itself. A fund, an accounting fund, keep in mind, an accounting fund is a separate chart of accounts. It has its own assets, liabilities, equity, income, and expenses. A fund can have restricted and unrestricted money in it. As far as an accounting fund, like we use the fund for a lot of different terms, so that's why I'm making sure I'm specifically saying an accounting fund. The asset account, not the asset, the net asset, that's why I kind of use the term equity. The equity account itself, you designate the equity account, whether it's restricted or unrestricted in there itself. So the designation is on the equity/net asset account of whether it's restricted or unrestricted itself. So, this is our unrestricted net assets is unrestricted. If I go here to missions, and then see, we've got a missions restriction. Let's just go to memorial. I've got a memorial donor restrictions inside of the general fund. It is marked as temporarily restricted. So you can have an accounting fund. There again, the definition of accounting fund is a complete separate chart of accounts, a self-sustaining chart of accounts. It has its own assets, own liabilities, own equity, own income, own expenses. An accounting fund is a self-contained accounting entity. You can have restricted, unrestricted money in it. Now, you could have a particular accounting fund that you could have you could have all the equity accounts in that particular fund all be restricted in there, and so that is possible. Okay, our church building is fully paid off, but when I run the balance sheet, the building's not listed as an asset. Again, I just took over in April. Assets are listed, are set up as checking accounts and savings accounts, and there are several accounts earmarked listed under which which I'm assuming should technically be listed as restricted assets. Yeah, I mean, if the earmarks, well, it all depends on earmarks. What is proper process for making a journal entry to get the building on our balance sheet? I'll tell you what it is, and then we'll just, this is not accounting advice, it's just accounting information. right? So if to put a balance like that on your asset on your books, you're typically, in this case, you want to increase the asset account. It means you're going to debit it. And then the offsetting of that, because it's not income, it's not expenses, you're just adding it to your balance sheet. You're going to offset that, in this case, to unrestricted net assets or unrestricted equity. So the accounting transaction is debiting your building account and crediting your unrestricted net assets account. Now, since your church building is paid off, that might actually, putting it on your balance sheet may confuse the matters for your board. So you may choose not to do that. I put it on our example because with a mortgage on it, it makes our net assets upside down if we don't have the asset of the building to offset it. That's there. So that's something for you to consider with your church leadership team of whether they want that on the books or not. If you're a for business account, for business, you're depreciating. There's some other things to go through there. So that's how you would do it. Now, whether you should do it or not, you're going to have to make that decision and work with your leadership team to see if that's, what decisions you're going to make by putting that on there. Okay. All right. Did we get everything, Justin?
Yeah, it's dangerous, but let's do a last call on any questions that you might have. But we'll give a second. But yeah, if you want to, I just posted the link again to register for our the next summer of accounting webinars. You can go ahead and register now, and there'll be a couple reminders leading up to it. So don't worry about registering and forgetting about it. And then we'll still bug you a little bit closer to make sure you can join us than if you forget. But that'll be a way to kind of mark it on your calendars so you can schedule, because we know the summers get crazy around churches with trips and vacations. So go ahead and register. It might be a good idea. But we got two down here, and then we'll call it a day after this if that's all right with you, Jeff.
Okay. All right. So there was can you change an account to restricted account if it's been listed as unrestricted? I'm in the same boat. Previous person had things set up, but I'm noticing all of our contribution accounts are not set up as restricted. Yes, you should be able to. That's really just changing some internal things inside the program. It's just going to move it a little bit at how it is. If you go back and run history reports, they'll move a little bit, but it's not going to change any balances by changing that. When using the release from restrictions button when recording an expense during the designated funds, does an expense go under unrestricted net assets or as a separate section for designated expenses? Very good question, Ruby, and you are setting up our whole webinar in August. So the quick answer for that is when you're using the release from restrictions button, you set up all of your expenses to go to unrestricted. And you use that release transaction to actually release them. So we'll go into depth in that as to like why to do that and kind of why the reasons to use the release accounts. I didn't want to go that level of deep this time. So for everybody who's still here left, there's still 120 people. Come back in August and we will do a huge deep dive into the fascinating topic of donor restrictions. And Justin's smiling because I've already bored him greatly with how donor restrictions work.
But my brain's hurting a little bit less with each conversation, so I appreciate it. And again, I hope thank y'all for joining us. I really hope that y'all got some helpful information. And we don't say this lightly, but thank you for letting us serve you as you serve others. And
Yes.
Thank you. We hope you have a great end of the month, and we will see you all in June.
Yes.
Thank you all.
Thanks, everybody.
Bye.